GameStop. Will this make you a multi-millionaire still? Or is this a flaming turd on the verge of bankruptcy? Welcome back to Strongman Personal Finance. GameStop just reported earnings, and what I like to do is go through the financial statements. I know it's boring. I'm not going to tell you to buy call options. I'm not going to tell you you're going to be a multi-trillion bazillionaire. I'm not going to feed you lies. I'm just going to talk about the numbers, and you can decide if you wanted to invest in it. And you probably will, because it's the future, bro. So let's go ahead and look at GameStop. I like to look at the big picture first. I like to look at the overview, the financials, over a period of time, and then we're going to go ahead and dive into the 10Q, the quarterly report, because they just reported, and oh my god, the earnings are, we'll see. So we got GameStop here. It's got a market cap of $5.76 billion on revenue of $5.81, trailing net income of negative $99 million. That means they're losing money. They have a forward PE of 36, so they're actually projected to be profitable. Analysts, who you can't really trust because they're clowns, say sell, and they have a price target of $6, okay? $6. I wouldn't trust that either. Let's go ahead and look at this company's revenue, my avenue. So what do you see right off the bat, ladies and gentlemen? This is their quarterly revenue since 2013. I don't know about you, but I see a downtrend, okay? Every fourth quarter, they have a spike in revenue because it's the holiday season. But even the spikes are starting to dip. This is a slowly dying company, at least from a revenue perspective. Let's go look at margins. Their margins are compressing, okay? Over time, they had a little bit of growth in gross margin, and now it's come back down. Operating margin has been basically negative for the past 5 years. Negative operating margin. This is their profit before interest and taxes. And then their profit margin, of course, is the same thing because now we're deducting interest and taxes. Free cash flow, a little bit better than operating margin and profit margin, but I see a lot of negatives, especially in the last couple of quarters. And guess what? Guess what, ladies and gentlemen? I think there's a hidden risk that a lot of you are not seeing in GameStop. So this is the overall income statement, okay? These are the comparative income statements. We see declining revenue and we see margin compression, and they've been unprofitable from an operational standpoint for a significant amount of time. Now, somehow, they're still buying back shares. They issued a little bit during the pandemic, but they bought back shares, it looks like. Interesting. Let's go ahead and look at cash flow. We'll look at the balance sheet in a bit. So we can see that their operating cash flow, this is the cash flow from their core business, is trending down, okay? If your operating cash flow is trending down, that's not good. You're not growing the cash flows from your business. Capital expenditures, they're slowing down capital expenditures. Is that a sign of a growing company? I don't know. Acquisitions, it looks like they had some kind of divestiture back in the last quarter of 2018, but they've had no acquisitions. Dividends. Oh, it looks like they suspended the dividend all the way back in 2019. Common stock issued. It looks like they issued some shares during the pandemic. That makes absolute sense. So on the overview, we have declining revenue. We have margin compression on the gross margin. That's the top of the income statement. We have negative operating margin. We have basically negative profit margin. And we have contracting operating margin. And we have a decline, a massive decline in capital expenditures. What's going on with this company? Check out the pinned comment below and join our Discord community where you can ask me questions directly via text. And if you sign up for the highest tier, you can actually meet me in person every 2 weeks. So check out the pinned comment, join the Discord community, and let's make some money. Let's go look at the most recent earnings. Net sales. This is their income statement for their most recent reporting period. Their net sales year over year are up about 2%. Okay, they've increased their sales less than inflation, but they have increased their sales, their revenue. This is before you deduct any expenses. Their gross profit has improved. I did the math a little bit earlier, about 8%. So they grew their gross profit faster than their revenues. That's a good thing, but I don't think it's going to save this company, okay? Now, gross profit is just taking the sales minus the items that are sold in the store. So, they buy a Nintendo Switch, and then they sell it to a customer that comes in the store. That profit is reflected in gross profit. Selling general and administrative expenses. They have cut expenses by about $65 million from the prior quarter, from the prior year. That's pretty good. Their operating loss has massively contracted. So instead of losing $107 million like they did last year in the same quarter, they only lost $16 million. But they still have an operating loss, okay? They're going to have to cut more expenses and continue to increase and improve gross margin. Interest income, very, very interesting. Their interest income has actually gone up significantly. Why? We'll go look at the balance sheet in a second. But with high rates, if you're buying treasuries or you're parking your money in bonds or whatever, you're going to generate more interest income during a high rate environment. Just like my money market account is, okay? This is a temporary thing. I would not count on this in the future, forever into the future. Other income, $2 million, could be anything. Loss before taxes, 3. And then they got a little bit of tax benefit for a total net loss of $2.8 million. It's an improvement, okay? They are narrowing their losses. So let's go down and look at the balance sheet. Now here is where I have a cause for concern. Okay, there's a very interesting thing going on in the balance sheet, but let's go line by line. So we can see cash and cash equivalents have gone down by about $6 million. So they used $6 million of cash. It could have gone anywhere. But they parked about $300 million in marketable securities. Okay, this could be treasuries. This could be whatever. This is where their interest income, these two locations right here, these two balance sheet accounts, is where their interest income is coming from. Don't count on that in the future. At some point, I don't know when, rates will come down. Receivables, this is money that's owed to them. Down a little bit, nothing crazy. Merchandise inventories, a little bit lower from the prior year. And prepaid expenses, much, much lower, okay? Their total current assets are $2 billion. Mostly in cash and marketable securities and inventories. So they're highly liquid assets. Their cash, cash equivalents, marketable securities, and receivables is, over $1 billion. Okay, about $1.3 billion. Not bad. We compare that to their current liabilities. This is money that's owed in the next year. They have enough cash to pay off all of their current liabilities. Okay, that's decent. They're not going to imminently go bankrupt, at least within a year. In the long run, we'll see. But they do have sufficient working capital where they're not going to go bankrupt. They have more current assets, especially liquid current assets, than liabilities. Long-term debt, they really don't have a lot of long-term debt. Operating lease liabilities, these are just leases they've signed. These are the future payments of the leases they've signed. And other long-term liabilities. So their total liabilities are $1.5 billion on $2.8 billion of assets. They have positive equity. Now let's compare long-term debts to long-term assets. Property, plant, and equipment. This is the stores they own, okay? They have $119 million of book value for these stores, and they don't have a lot of long-term debt. So overall, they're not underwater. Not the worst balance sheet I've seen. But there's one thing that really stands out to me. Property, plant, and equipment, net of accumulated depreciation. If you take the value here and you add back the accumulated depreciation, that was the initial cost of the assets on the balance sheet. Notice that they have a ton of accumulated depreciation. This is recognizing the expense of capital expenditures over their lifetimes versus not much in book value for those assets on the balance sheet. What does that mean? That means a lot of the stores they own are really freaking old, okay? Very, very old stores. And what happens when you have old crap? It starts to break. It starts to cost money. What does that mean? I think in the future, they're either going to have to spend a ton of money on capital expenditures or they're really going to have to downsize. And where is that money going to come from? Okay, they're probably going to downsize is what they're going to do. Where's the money going to come from? Well, I mean, they have enough cash and receivables to pay their short-term debts, but for long-term financing, they're going to either have to borrow a bunch of money to upkeep their stores or buy new stores, or they're going to have to issue shares if they don't downsize. But a lot of their property, plant, and equipment is really freaking old, okay? That tells me they may potentially have a lot of capital expenditures in the future, or they're going to have a lot of divestitures, and that is going to shrink the business even more. If they decide to sell these long-term assets, and they decide to cut off a lot of the fat, which they'll probably do, lean up the business, their revenue is going to be impacted, okay? They're probably going to close a bunch of crap stores that don't perform. That's my guess, because they don't have the money to be able to afford to replace a lot of their property, plant, equipment, their stores. This is the biggest thing that I notice on their balance sheet. Overall, their balance sheet's great. You know, it's awesome. It's wonderful. You know, they're able to pay their short-term debts. They're not underwater on their long-term assets. Everything's freaking great. But they do have a big problem with property, plant, and equipment. And how they're going to approach that, I'm not 100% sure, but that's an issue. We go down and we look at the statement of cash flows. Look, negative operating cash flow. In the last 6 months from the prior 2 quarters, they've burned $211 million of cash from their core operations, okay? The prior year, they burned in those 6 months $407 million. They are negative cash flow. They have negative operating cash flow. That is horrendous, okay? They have negative margins. They have, well, at least in the last quarter over quarter, anemic revenue growth, but really it's been contracting over time. And they have very old property, plant, equipment. They're going to contract this business, okay? They're probably going to sell off a bunch of stores because they can't buy new stores with their business. They're not making any money. They're losing money. Where's the money going to come from? They're going to have to go into debt, which is probably not good because now we have high interest rates. Or they're going to have to issue a bunch of shares, which is going to tank the freaking stock price, okay? This company is in trouble. In the short term, they're going to be fine. But this isn't this amazing turnaround story. It's not, okay? At least not yet. There's still a lot of things wrong with this business. Let me know your thoughts. Talk to you later.